Joining us now is Satori fund manager Dan Niles. And your advice, Dan, this year has been don't fight the Fed, which on a day like today rings true. But you would have missed a pretty nice midsummer's rally and some nice rally opportunities as well on the idea that inflation is coming down. How do you read what's happening today?
Well, I mean, as you brought up, Sarah, don't fight the Fed and don't fight the fundamentals, which is the second part of that. And you're right, you've had some great rallies. If you had invested during the Great Depression, you would have made 8 different rallies that averaged 24% on the way to losing 80% of your money. So if you're nimble enough to trade around those rallies, then yes, you can make, great returns. This year alone, we've had 5 rallies in the S&P 500 that have averaged, I believe, about 9% each. So if you caught all of those perfectly, you'd be up 45%, but you're unfortunately down 16%. So I think for the retail investor that can't, daily trade their portfolio, you're better off losing, as we've said consistently this entire year, 5 to 7% to inflation than potentially 30 to 50% to a market decline, which I think will continue into next year. So that's how I think about it. And if you look at my Twitter feed, obviously we've talked before about when we think rallies will begin, which is easier to predict based on technical analysis. Tops are a lot harder to pick out. But the simple thing to think about is until the Fed is done raising rates, until we are inside a honest-to-God recession where you've got unemployment spiking, all you're trying to do is catch bear market rallies, and then you're going to lose even more money on your way down.
So what should you do? You're 25% in cash right now, Dan? What's the rest?
Yeah, well, we have a lot of shorts, as we've said all year. For us, it's typically been ramp up the shorts when you've got a nice little rally, if you think the fundamentals are still getting worse. And then, as you think the market's hitting bottom and you've gotten to an oversold condition, then take those shorts off and then put them back on again. And so that's kind of what we're doing. So our longs are in defensive areas, such as Walmart. If you look at Walmart in 08 with the S&P down 38%, Walmart was up, I think, about 18% or so. We think Amazon also might be able to be somewhat of a defensive long in the sense that we think as people get more price sensitive, they're likely to look for bargains on places like Amazon. So that's another place.
Although Amazon's never really acted defensively as a stock, has it?
Well, exactly, because the multiple's been so astronomically high.
Exactly.
Yeah, exactly. So, but you got to remember, no long in our portfolio is by itself. So we've got tons of shorts in retail matched up against Amazon. And in fact, for Amazon in particular, we've got ad names in the internet where we think advertising, if you look at 08, 09, advertising revenues went down over 20%. The internet, though, was only about 12% of total advertising dollars in 08, 09. Now it's 66% or 2/3 of the market. So big ad-supported internet companies are not going to be able to avoid a recession. They're going to see their businesses get hit pretty hard. And so we've got that matched up against an Amazon where we think shoppers are going to look for bargains, just like they're going to look at Walmart. We like Walmart better, obviously, because, in 08, the stock was up a fair bit. So that's a good area. We have some stocks in healthcare where things have come down, another defensive area. And we own a lot of commodities. So oil, copper, coal, solar, those are areas that we're in. But just to be clear, those are matched up against shorts. We think all of those names, though, should be able to outperform as the market goes down another 20-25% to get to its ultimate lows sometime mid-next year.
As we speak, we're looking at new lows for the day. The S&P is down 4% right now. The NASDAQ comp down 4.86%. And the Dow Jones Industrial Average is down a stunning 1,180 points as we speak. Again, it's very broad. It's hard to spot any winners. You've got, I think, 5 gainers in the S&P. One is Twitter, and the rest are fertilizer stocks. So, Dan, when you talk about some of these tech names, how do you know when they've gotten too cheap and when there are real signs that perhaps inflation is turning?
Well, remember, there's 2 parts to a stock price. There's earnings, and there's the multiple to those earnings. So if you look at the S&P 500, what are we talking about today? We're talking about inflation, which I have said all year is going to remain higher than what people think, even though it's likely to have peaked and come down, which is what you've seen, right? Headline inflation has come down, yay, but it's still higher than what people think. And if you look at over 70 years of history, when the CPI is above 5%, the trailing S&P multiple is 12 times. Today, it's 19 times. If you want to be super optimistic and say we're going to get it down to 3%, then the trailing PE multiple is 15 times. And again, we're at 19 times today. The second piece of this is earnings. And the S&P 500 earnings for 2023 is around 250 is where it peaked out. You've seen the first reduction in those numbers in 2 years. And I think you're going to see that get worse. You've already seen companies like Intel soft pre-announce after giving guidance 6 weeks ago. You've seen Corning soft pre-announce. So you already got numbers getting revised lower, and now those revisions are moving to the higher multiple sectors of the market, where a lot of the enterprise software names, such as a ServiceNow or a Salesforce, you're starting to see that weakness in fundamentals spread from consumer earlier in the year to now enterprise is starting to feel that slowdown as well. And that's where a lot of high multiple stocks sit in the software space. So that's one area where we've got a lot of shorts, a lot of the cloud-oriented software names in particular. That's where we're kind of focused on the short side.